A lot of homeowners right now feel like they have golden handcuffs. They're locked in a 3% interest rate, and now they feel stuck in their house. But what if I told you the house you already own could actually become the down payment for your next one? Let me show you what I mean. I've had a lot of conversations recently with homeowners who say the same thing. Ryan, we'd love to move, but we can't give up our interest rate. I completely understand that. A 3% mortgage is an incredible asset. But what many homeowners don't realize is that over the past few years, they've likely built a significant amount of equity in their homes. Let me walk you through a simple example so you can see how this works. I'm going to show you how a home that was purchased a few years ago is now worth $450,000. There's a $180,000 balance on the mortgage, and we can easily pull out 6 figures in equity to use for the next accusation. By the way, if we haven't met before, my name's Ryan Spath. I'm a realtor and real estate investor here in the Treasure Valley with Keller Williams Boise, and I spend a lot of time helping people think through strategies like this. So here we go. On this example, like I'm talking about, if the home is worth $450,000 now, we owe $180,000 on our mortgage. We have $270,000 worth of equity. What the common thing that people do, they'll take this 270 grand and they'll roll it into their forever house. Yes, it feels good. Yes, it's tempting. Yes, I've thought about doing this myself. Here's a better way of thinking about it. If we do a cash out refinance and we pull $120,000, we're going to have a new loan of $300,000, and we can use this $120K to either buy an investment property, or we can turn the property that we did the cash out refinance on into an investment property and buy another house that's, maybe just a little bit better instead of that forever house that we're hoping for. Let's see how these numbers actually play out. So with the property, it's worth 450 grand. And to get this out, like I mentioned previously, we're going to have to pull some money out. So with a 32%, we're going to leave in the equity. That's how much equity we're going to leave in the property. We're going to have almost a 70% LTV here. The rate is going to be a little bit higher. We're going to want to get with a mortgage professional, someone like Sonny Knudsen at Unlimited, and dial these exact numbers in. But for this example, we're just going to use some basic assumptions just to kind of roll through the numbers. The taxes on this property, this is a real property that I own, so these are real numbers. The taxes are a little bit over $2 grand. The insurance is a little bit over $700. And I know that we are now going to be able to rent this property for just under $2,400 because it's for rent, and this is the amount that it's looking like we're going to get based on the applications received. So when we take all these things into consideration, we're going to make a couple $100 on this, you guys, which isn't huge. This property was acquired in 2019, and we are going to want to take some things into consideration if we are going to do this. If this is going to be the only $200 that we're able to save beyond whatever we do with our W-2, maybe we have a business, etc., we may want to really consider this, because investing in real estate is a capital intensive business. This property, like I said, it was purchased in 2019. It's 7 years old. So likely in the next 5 to 7 years, we're going to have to make some capital expenditures in the property in the tune of the HVAC. We're going to start having to keep a close eye on that. It's likely going to need to be painted inside and out in the next 1 to 3 years. When you are investing in real estate, there are things that you have to do to keep up with the property. So with this one, as I mentioned, you can see we're going to be able to pull out $120,000, and we're going to use this to acquire a new asset. The purpose of doing this is the current asset that we have that we're living in, that we feel that we're handcuffed to, we're going to now turn this guy into a rental property, and we're going to buy the next primary residence that we're in. If this sounds like something, a strategy that you want to dive into, you want to learn a little bit more about, please feel free to reach out to me. These are the kind of conversations that I love having. I love helping people build wealth. And I'd love to just have a conversation with you and see if that property that you feel like you're handcuffed to is going to be the first property that's going to be a rental property for you and your family and change the financial direction of you and your family. I hope you got value from this video, and I'll talk to you soon.